Thursday afternoon, I'm Eoin McGee, financial planner. I've just come off air with Ciara Kelly on Lunchtime Live, and the questions that we didn't get to on air, we're going to talk about now. We're going to answer the questions. We have a little bit of space, so do get some more questions in if you've got a few.
Okay, so the first question comes in from Craig. So he says, myself and my partner have secured our mortgage in approval, but our house won't be built for a couple of months. If we reduce our savings a small bit now between now and renewing our approval, will that affect it?
So you've got mortgage. So Craig already has mortgage approval, and it's going to be a few months before he actually gets the house or gets into the house. And he's wondering about the fact that if he spends some of his savings, could it affect his mortgage approval? The reality is just make sure you leave yourself enough money to pay for the deposit or whatever balance of deposit has to be paid, for solicitors, for whatever else. But it's very unusual if the mortgage takes a long time to draw down. Sometimes you have to go through all the process again and show them everything. But more often than not, what happens is once you're approved and you've picked your house and the valuation has gone into the bank and everything else, the only final checks that they will do is they might do a credit check on you to make sure you haven't borrowed money. And they will also... they will often, the day before they post you the check, I'm talking about the bank, and when I'm talking about they will often ring your employer just to make sure you haven't lost your job since you applied for the mortgage itself. Savings, provided you are covering the deposit and all the other costs and you're not going below that level, it shouldn't be an issue. Like, let's face it, the bank know you're buying a house. They know it's a costly time, but don't go off like an around the world trip or anything and blow a load of money. Be sensible about it and make sure you can justify what you're spending on. You do have to answer them till you get your mortgage check. After that, you can spend your money on whatever you want to spend your money on.
Okay, so the next one comes in from Shane. So what stage do you pay your solicitor at in terms of mortgage? We're about to get mortgage approval in principle, but we don't need to draw it down until next year. Do we pay fees now or later? Ideally, we'd like to pay them later. Okay,
so the question is, when you're doing a mortgage, when do you pay your solicitor? So you've got mortgage approval now. You're not drawing down till next year. You'd prefer to pay the solicitor next year and not now. In general, what you'd find is when the case is being closed off. So the conveyancing done, you've signed for the house, you're walking out. Usually they hand you the keys and you hand them the check. That's usually the way it works. But just make sure that that's the way your solicitor's working. They might look for some money up front and some later on. It would be surprising for them to ask you for all the money up front now. The ordinary thing, but I'm not a solicitor, so hopefully solicitors don't ring in or text in saying you shouldn't have said that. But the ordinary run of events would be you'd pay on completion when everything is done. You get your keys, they get their check.
Okay, so the next one comes in from David. So, hi Eoin, I'm 28 years old and I recently got a claim of €9,000. I'm not in a huge rush with spending the money. Can you tell me what's the best way to save it? Are these no-brainer funds an actual guarantee that I won't lose money?
There is so the question is, it's just got €9,000. They're in their late 20s, and they've been given a sum of money of €9,000, and they're wondering what to do with it. They don't know, they don't have any immediate plans for them, so it's a long-term investment. Obviously, someone who listens in regularly or watches this because he's talking about the no-brainer portfolio. If this is the first time watching this, no-brainer portfolio is 60% shares and 40% other stuff, usually bonds, but it's a no-brainer portfolio. And that's for things when you are investing it for 5 years plus. Less than 5 years is bank accounts. More than 5 years, if you're not getting advice, just go with a no-brainer portfolio. The question though was, are these things guaranteed not to lose your money? Absolutely not. They can lose your money, but it's about diluting the risk. The way to dilute the risk with a 60-40 no-brainer portfolio is time. The longer you leave it there. Let me give you the stats. If you put money into a 60-40 portfolio based on history, in 12 months from now, 1 year from now, you have a 1 in 4 chance. There's a 25% chance that 60-40 portfolio is going to be negative. Now, look the other way, there's a 75% chance it's going to be positive. 3 years from today, there's a 15% chance it's going to be down. That's an 85% chance it's going to be up. 5 years from now, there's a 98% chance it's going to be positive. A 2% chance it's going to be negative. 7 years from now, and this is why we go beyond 5 years. 7 years from now, based on history, a 60-40 portfolio has never lost money over a 7 or more year period. And that's why we always talk about the idea that if it's less than 5 years, the stats are just too much to gamble with, and that's why you have to put up with bank accounts. But go beyond 5 years. Remember, 5 years is a 98% chance you're going to have a positive return based on history. So that's why it starts to become more attractive to go into these long-term funds. If you're going to take your money out in less than 5 years, I'm giving you zero guarantees. But more than 5 years, it starts to flush out all of those problems. But still, there's no guarantees. Things that's based on history, the future may not be the same as history.
Okay, so this comes in from Connor. So just wondering if you could explain Revolut to me. How does it work and is it safe?
Okay, so Revolut is one of these new fintech banks. There's a couple of them on the market. There's Revolut, there's N26, and An Post are actually kind of sort of entering, not kind of sort of, that's unfair. An Post have brought a lot of the features from Revolut and N26 to their new current account offering. So let's just talk through some of the offers. There are a few others, but they're the main ones. Let's talk through. N26 is a German bank. It's regulated by the German, the equivalent of the central bank over there, and it is very large across Europe, and it operates here. Revolut is a UK firm. It's an entity. It isn't regulated. It's not a bank itself, but it is regulated, and it places all the money that you give it with Barclays Bank, which is a bank, obviously. And I believe Revolut are looking for a banking license themselves, but right now they're not a bank. And then An Post is An Post, and we all know who An Post is, so we don't need to go into that, and they're regulated by the Irish Central Bank. Now, with Revolut, because the question was specific around Revolut, some of the nice things about Revolut are that you put your money in, you have your card the same way as you always do. They often charge you money for taking money out of the ATM once you go over certain limits, but they have little things, little features that I really like. There's a thing called Roundup, and N26 and An Post, I believe, have this as well. I know N26 do, I believe An Post does. They have a thing called Roundup. So imagine you go into a shop and you buy a can of Coke and a packet of crisps, and it comes to, I don't know, $2.72. And if you tap that with your card, $2.72 comes off your card. But you can tell Revolut that to round up. And what round up means is, instead of $2.72, it'll round it up to €3. Now, I would argue that in 3 weeks' time, you won't remember it was $2.72. You'll remember it was €3. So what Revolut is very clever doing is it takes that 28 cents and it puts it into what's called a vault. And the vault is just a kind of a subfolder of your bank account, and you start to accumulate up what some people have described as free money. It's just rounding it up all the time and putting the spare change into this little vault, and you can move the vault back into your bank account whenever you want. It's just using technology to be more clever about your spending. There's lots of other little features. The other question was, is it safe? It's ultimately, it is regulated. I think this question actually came to me directly on Twitter from somebody during the week. My answer to that would be, is AIB, Bank of Ireland, Ulster Bank, EBS, I'm trying to name them all because I'm not trying to isolate anybody, but are any of the banks safe? They have different regulation around them. The only thing I would say about the whole thing is that I think they've nearly 750,000 customers now between N26 and Revolut. Now, we could all be wrong, maybe. But is it safe? Nothing is ever safe, including the high street banks that are here. But there is regulation around them, and the money is segregated into a Barclays account. I do believe there's some chatter online about the way it's segregated and everything else, but it's a really difficult question to answer without it having a full banking license.
Okay, so this comes in from Brian. So what's the best way to save for young children's future third level education costs? So
third level education costs are one of those things that you're allowed to pay for your children that don't come out of your allowance. So in your lifetime, you can give your kids €320,000. That's 320,000 in total from mammy and daddy down to child. And each child has a 320 allowance. So it's not 320 from mum and 320 from dad. Certain things will come out of that 320. So if you just give them 10 grand, it comes off the 320. If you give them a deposit for a house, it comes off the 320. If you pay for college, it doesn't come off the 320 because that's considered the cost of raising a child. And that the cost of college, therefore, should be done in an investment in your own name, because by investing it in your own name, if they decide not to go to college, you can decide to keep the money for yourself. And therefore, using it, if it's assuming the child isn't 13 years of age and going to college in the next 5 years, I'd suggest you find a regular premium long-term investment and try and go for a no-brainer 60-40 portfolio. That's the best way of doing it. Now, if you did want to pay for your child's deposit for their house, that's a different type of savings. In any given year, you're allowed to give your child €3,000 and your wife can give, or your husband can give, the same child €3,000 as well. And what you do there is we would often take it for clients where we'd say, right, you can afford to give that child €6,000 a year. We'll take that €6,000 this year. We'll set up a savings plan for it. And every year, and let's say after 10 years, you put in 60,000 and it's grown to 70,000. You give them that as the deposit for their house. That 70,000, because you've used the gift allowance on a year-to-year basis, doesn't come off the €320,000. threshold. So it's a very clever way of providing for things that you're not allowed to provide for without coming out of the threshold. So a little bit complicated. You do need advice on it because there are lots of other things you can do around the inheritance tax side to try and limit the inheritance tax bills. But that's one of the really clever ways of using up the gift allowance, putting into the child's name, and it does go into their name. And if they turn 18 and go in a direction you don't want them to go with, it's their money and they can access it if they want to, because you've given it to them each year. So best way to do it, 60-40 portfolio, and you pay for the college for them.
Okay, so this comes in from Sharon. So, Owen, is it worth contributing to AVCs even if they exceed the lump sum that I can withdraw tax-free from at retirement?
So the question is it worth paying into AVCs even if my AVC pot is going to be greater than the lump sum, the tax-free lump sum I'm allowed to take at retirement? The answer to that question is yes. There is nowhere else that you can have a more tax-efficient way of saving. You put in the money, you put in €100, it costs you €60 to put in 100, because when you put €100 in, you get €40 back in tax. So there's no not only that, when it goes in, it grows tax free. And when you come out at the end, even though you've already maximised, you've told us you've maximised your tax-free lump sum, it still has an effective tax rate, which is better than if you had just taken in a salary in the first place. So the tax-free growth is very attractive. Don't underestimate the power of that, but also the tax relief on the way in is really powerful. So it is. The only thing, if you already know that you've maxed out on your tax-free lump sum, sounds like you might be part of a defined benefit pension scheme. We're not going to get into that now. Just be careful. There's a maximum 2 million limit, and you might go, there's nowhere near 2 million in my pension pot. When you go over 2 million, you do start to get taxed very heavily. But the fact that you're talking about maximums already, just make sure someone's run a calculator across it and you're not going to break the 2 million limit.
Okay, so this comes in from Mary. So Mary was one of the people affected by the tracker mortgage scandal. So she was made redundant in 2011, and because they were on a variable rate, they decided to use her redundancy to clear the mortgage of nearly 200k. Her only reason for that was doing so because she was told the rates were going to go up. So she got a refund of, say, over 5.5k, but she's appealed this because she feels that there's more money owed to her. She also feels that maybe 10k is not enough compensation.
So basically, you were part of the tracker scandal. You were given a different rate when you should have been offered a tracker rate, and the bank, sounds like the bank did give you some money as a redress, and you don't feel that it's the right amount of money. It's really interesting watching the report come out from the central bank this week, and actually one of the things that struck me from the central bank is just how tied their hands are. They are kind of sort of trying to use their powers without any legislation to back them up to really force the bank into certain situations. Let's look at it like I believe the people who did actually lose their homes entirely in the tracker scandal, the average payout to them was a just under 200. I think it was €194,000. So that gives you a bit of perspective in terms of, yeah, you've used redundancy money to clear off your mortgage because you were worried about the rates and you were worried about not being able to afford it, and I get it and I understand it, but just make sure. Now, €10,000 is a lot further away from €194,000. My suggestion to you is go to some of the people who are very heavily involved in this and ask them to review your case and see if it's worth continuing to push it. I do know of people who have pushed this with the banks, and they have got to a stage where they're pushing it and they're going to bring it to the ombudsman, and the banks have come back and offered a little bit more to stop the case dead in its tracks. But that's not necessarily, it's a very long road, and it's not necessarily going to be the same for you. The best advice I can give you is find somebody who is doing this all the time. And there's a few people out there, you'll hear them in the radio, you'll hear them on Newstalk all the time, but find somebody who is very regularly talking about this in the media and go to them and ask them would they have a look at your case, and they will give you a much better steer on it. Because these things, they are very personal, and they would have other cases that would be very similar to yours. I've no doubt about it. So that's the best advice I can give you.
This one comes in from Sandra. So, hi, I wanted to ask about mortgages. When the bank are looking at affordability, do they base it on 3.5 times your income regardless of how many kids you have?
So 3.5, whoop, are we okay? Yeah, okay, I just kicked the camera. So 3.5 times your income is, so the question is that when the bank are looking at you for a mortgage purpose, is the 3.5 times your income the only thing they take into account when it comes to affordability? Now, affordability is how much can you afford to repay on a month-to-month basis, or do they also take into account how many kids you have? Let's just be really clear. Some people have this misconception that you take your salary, you multiply it by 3.5, and that's it, full stop. Whatever 3.5 times your salary is, that's how much of a mortgage you can get. it's not exactly the case, because the other thing they have to do is they have to have this thing called net disposable income. And what net disposable income, it's a calculation that they do. They say, okay, this is your take home pay, and your take home pay, let's just to keep the math simple, let's imagine your take home pay in a month is €1,000, and they say about 35% of that, or not about, depending on your income bracket, 35% is €350. But after they say, okay, so you can use €350 to service your mortgage on a month-to-month basis. Out of that, they might take car loan repayments or any other loans, and they take that out. But once they've worked out what the mortgage repayment is, they've looked and they've ticked a few boxes, the final check that they do is okay, if this person pays this mortgage, how much have they got left over to cover their own living costs and the living costs of any kids that they might have? And they all get added up to make sure that you've got enough money left over that you can afford to make the mortgage repayments and live your life. That's why lots of banks, if you're on less than €25,000 a year, lots of banks won't entertain you at all, because they don't believe that you have enough disposable income after you've paid off the mortgage on a month-to-month basis just to live your life and feed and clothe yourself. So the answer is 3.5 times is the starting point, but there's a load of other calculations that get done in the background.
Okay, so this comes in from Eoin. So I'm on job seekers whilst working part-time as somebody who's self-employed, earning about 8k per year. How does being self-employed affect my PRSI contributions?
So if you're on job seekers, that's the thing that's protecting your PRSI contributions as opposed to being self-employed. Being self-employed is a different class of PRSI contributions, but you can opt to pay a little bit more if you wanted to, and it is becoming much more equal. So what's happened over the last few years is, and the Taoiseach has actually very clearly come out and said we want to equalise the self-employed and the employee situation when it comes to social welfare, and to equalise it even when it comes to taxes and everything else. There's a PAYE tax credit that you get as a PAYE worker that you don't get as a self-employed person. That's been equalised over the next couple of years as well, and that's already started. So I would suggest, again, if you're already in the job seekers thing, go into the Intrio offices. They can be really good for giving you some information, or even just ring the Citizens Information Bureau. They'll be able to look at your own particular case, or look at socialwelfare.ie. They'll be able to look at your own particular record and tell you how your PRSI contributions are being collected or not being collected, whatever the case may be. It's a very personal question in terms of, it's hard to give advice without knowing exactly your own situation. But what I would say is I would be more confident that you're protected from a job seeker's perspective as opposed to the self-employed piece giving you the PRSI contributions.
So this is from Steve. So can you see the sterling rising again? I live overseas and my pensions have been reduced to this turmoil.
Okay, can I see the sterling rising again? That's a little bit like, is Brexit going to happen? Is it not going to happen? Who knows? And one of the things I would say to you is, and particularly in the short term, I'm glad you used the word pension at the end of it, because it must be that you're thinking longer term. Longer term, what I would say to you is that if you're living in euro and your money's in sterling and you plan on spending your money in euros, at some stage over the next couple of years before you start drawing down that money, you need to convert it to euro. And anybody who tells you what's going to happen in sterling and particularly in the next 12 months, is either guessing or lying. They haven't got a clue, and they can produce all the models they want, but actually it's a guess. Maybe it's an educated guess, or it's a lie because they just don't know. But if you're thinking about longer term, one of the tricks that we would often use, where we have clients who have sterling or dollars, whatever it is, and they're bringing them back to Ireland, maybe they've moved back here and they're now living here, and you could have substantial amounts of money being brought back into the country and they're converting them to euro, rather than taking one hit where you say, right, that day is the exchange rate I got, that's it. We would often bring the money back here, invest some of it or most of it in dollars or sterling or whatever currency it's currently in. And then over time, maybe even like if we have a long period of time, maybe even over 10 years, we'll take 10% a year and we'll convert it back to euro over that period of time. So remember, you can bring it into the country in the currency it's already in and invest it in that currency, and all of that can be done. But by moving it back into euros at 10% a year, over 10 times, 10 transactions, whether it's once a month for 10 months or once a year for 10 years, you're getting an average euro sterling conversion or an average euro dollar version. So it kind of smooths out any of the stuff, and you get a better long-term feel for what the truer value is of the exchange rate, as opposed to a distorted value for exchange rates, which is exactly what you would expect right now. You can't imagine that this is normal forever, but who knows what the new normal is going to look like whatever happens with Brexit. So my answer is, in the short term, haven't a clue. In the long term, there's a plan that you could actually move the money back over in a very concise way, pots at a time, and get an average cost over the term.
Okay, so this is the last question. So, hi Owen, we're just starting out with a mortgage broker. We have all our documents in order, savings accounts, etc. Any idea what the timeline would be until we get our approval, as we've seen a house that we're keen on?
Okay, so how long is it going to take you to get approval? It depends on the mortgage broker. It depends on what relationship they have with the bank. It depends on what bank they're going to send it to. And what I would say is you need to allow yourself a couple of weeks. If there's a real pressure on it, like if you've seen a house, sometimes it wouldn't be unusual for people to come and say, hiya, I put a deposit on a house last weekend, I have all my documents, or what do you need for me to get mortgage approval? The deposit, remember the deposit that you put down, the initial deposit you put down, and just clarify this before you give anybody money, is fully refundable. So oftentimes what you do is you put your deposit down, you either have mortgage approval already, or you are trying to go through the process of getting mortgage approval, or you're about to stick an application in like you are, and you've got a couple of weeks where you've put the deposit in, the contracts get sent to your solicitor, and your solicitor has time to review them, usually 3 weeks, and then you go in and you sign and you send them back. Now when you sign and send them back, now you're buying the house, and you won't be able to sign that without getting mortgage approval. But what I would say is allow yourself, like I think it depends, as I said, which bank it's going into, but if you've got all your ducks in a row and you've got all the documentation, you're well ahead of the curve, you need to get it into the mortgage broker as soon as possible, and I would say a couple of weeks is what you need to allow before you expect to get any type of answer or anything from the banks. So that's it for today. That was our Facebook Live questions on consumer. We will be back next Thursday, I'm fairly sure. But it's Thursdays at 2 o'clock, and we do answer them on air beforehand and then afterwards here for the ones we don't get to on air. Thanks very much for your questions, and we'll see you next week.